Chapter 2. In this chapter, we're going to learn about ratio analysis. If we know how to do ratio analysis, we can make sense out of any company's financial statement and quickly find out, is this company profitable? Are they doing well? Is the product actually in demand? Is the management active and using the products well and the assets well of the company? Are they using the resources well? Is the management taking on too much debt? So there's lots of forensics that we can find out if we know how to do ratio analysis. So let's get into this chapter and find out how to do ratio analysis. The number one most important ratio that we have is return on equity. If you remember nothing, remember this one ratio from this chapter, return on equity. Return on equity is the best proxy towards share price performance. So if your company's return on equity ratio is getting better over time, then your share price or your stock price will get better. And so return on equity is the most important ratio. So if you want to find out and compare two different companies, you want to find out what's the return on equity, right? But that's one takeaway. But return on equity can be broken down into three areas. So return on equity, ROE, equals profit margin times asset turnover times financial leverage. So if we agree that return on equity is the most important factor, then the next question is, how is the return on equity calculated? So it's calculated using these three. If you multiply these three ratios, then you get return on equity. So now if you find out that, hey, the company's return on equity is not good, then you want to find out which of these three sub ratios maybe is not good. So first you calculate return on equity, then you calculate and you go deep. It's like, oh, let me try to find out what the profit margin is. Let me try to find out how quickly they're turning their inventory and their assets, how efficient they are in utilizing their assets. And then try to find out, are they taking too much debt and paying interest and others, right? So the first ratio, starting ratio, is return on equity. Second ratio is profit margin, asset turnover, and financial leverage. If you multiply these three, you get return on equity. So stay with me. We will get to how we actually got here and one by one, right? So remember, return on equity depends on these three multiplications: profit margin, asset turn, and financial leverage. So let's understand this intuitively before we go into the details of the ratio. So think about this. Return on equity intuitively means, for this company that I have invested my money, what is the return that I'm getting for the equity investment I made? Let's say you buy a share in a company, you're buying equity. When you buy that share, you expect some return to come out. So that's what it is. Like, hey, should I buy this company or should I buy that company? So then you can ask a question, which one has a better return on equity? And which one has a consistent better return on equity over time? And then you may ask, okay, this company has low return on equity. Then you might want to ask, like, how is that? So how is a return generated, right? A return on an investment generated. The first factor is you need to build a product that is profitable, meaning you build a product for $10 and you can sell it for $50. So that means you have a margin, you have a profit margin, right? So now you somehow build a product, let's say, right? And you were able to build it for $10 and you were able to charge $50. So you made $40 profit. So that's the profit margin, right? But for building that product that you could sell for $50, you needed certain assets, like a factory. So then you have to use your assets effectively. So that's this part. How effectively are you using your assets? How effectively are the inventory that you build for the products that you have are moving the shelves, meaning how quickly people are buying, or are they just sitting there and wasting your money? And then the third part is, for you to buy these assets, you need to either have your shareholders and that invests in you, or you need to borrow money from the bank. So there's some sort of leverage involved. So to build a product, you need assets. To have an asset, you need leverage in some sense, equity or through debt. So if you multiply the three, then you get some sort of return. So that's the intuition behind how return on equity is calculated. So now let's get into the details, right? It's a widely used ratio. ROE is a widely used ratio for financial performance, but it has lots of limitations. So while I told you this is the most important, it is, but you have to We are getting better at this, so we need to understand like what are the limitations of return on equity. Well, it's a backward-looking metric, meaning return on equity is for transactions that have already happened, but we are trying to find out value of a company in the future. But history has a lot of precedents, right? Meaning what the company has done over a period of time, it will continue to do better over that time. Meaning if a company can generate a product for $10 and sell it for $50, the chances are high that next year they'll still be able to sell that same product for $50, if not at least for $40, right? So that's where you can find out that agreed that there's a timing limitation. It's a backward-looking metric, but it's still a good proxy. And it measures return, right? But it doesn't measure risk. You could be in debt and paying a lot of interest. So your return on equity would be looking good, but return on assets would be pretty bad. So we need to look at not just the return, but also look at the risk, right? And it also looks at the historical book value for returns. It doesn't look at the market value. And we know from accounting that the book value and market value can be hugely different. So even with all of these limitations, return on equity is still a good proxy for future share price appreciations. If you want to compare companies, return on equity is really good. Then you have a guardrail of return on assets, and you can quickly find out what's going on, right? So the first factor of return on equity is profitability. You have a product that can actually be profitable, meaning someone's willing to pay you more than the cost that it takes for you to build it. Meaning for every sale that happens, let's say a $50 sale that you make $40 profit, right? Because you made it for $10. So profit margin is just that. It summarizes from your income statement, how is the company doing? Does it have a margin? Meaning, can it make money? If you don't have a product that can make money, you're screwed, right? So it's basically a fraction of each of the sale dollar that goes in terms of revenues and what gets to the bottom line or the profit. So that's profit margin, right? You have a product that's actually good. If you do this deep analysis and find out that, hey, profit margin is poor, that means people are not willing to pay you more than the cost. So then that's a good understanding, like, hey, is the product actually in demand? Are they able to charge more for the product that they build? The second part is asset turnover, right? For you to build that $10 product that you sell for $50, you need to have assets like a factory, right? And so you need to effectively, as management of that company, need to manage those assets well. So if you want to find out, hey, is the management lazy? Are they actually generating those sales, and are how much asset they're using for it? And are they like turning their inventory, meaning the products that they have built, are they selling it quickly? Are they collecting money quickly from the people that they need to receive money from, and how slowly they're paying money out, right? These are asset turnover, like for what fraction of assets that you have put your money in and what sales is generating, right? So many factors come into assets turnover ratio, which we'll get into, but like it's very important to use your assets or your resources really efficiently. Finally, financial leverage, the third big part of ROE calculation. It summarizes the debt, right? There's some aspects of risk, right, that ROE factors in. And so think about this, right? You want to maximize certain ratios like profitability, asset turnover, but you don't want to maximize financial leverage, right? Because the more leverage, the more debt you have, the more interest you have to pay, and the more you are on the edge, right? So super important to understand, like, hey, the financial leverage is not something to be maximized, but it does play on your side if you use it well. So now finally, if we now bring all of this together, return on equity, profit margin, asset turn, and financial leverage, let's use and build ratios. And that the process of systematically looking at each of these ratios and analyzing the trend of like over time, how the company is doing and how it's doing compared to the industry, that's ratio analysis, right? And so there's lots of judgment involved in this, right? And there's no correct value saying, hey, this ratio is good, that ratio is bad, but at least gives you the starting point to ask a question like, hey, why is profit margin reducing, or why is the asset turn reducing or increasing, right? So you can ask those questions. So let's do this analysis. So remember this key formula: return on equity is profit margin, asset turn, financial leverage. If we multiply all three, we get return on equity. And so there are, for return on equity, for each of these, again, can be broken down into many more sub-ratios. So return on equity broken down into these three sub-ratios. Each of these ratios can be broken down further into many more sub-ratios. So let's look at one by one. Profit margin, you can look at gross margin, how much tax the company is paying. and what is the overall net margin, right? Like after tax, and what is the return on assets, right? Return on invested capital, price to earnings. A lot of that is profit margin. Asset turnover again has many more sub ratios. You can say how many days of sales the company has in cash, and how long does it take for them to collect from accounts receivable. How long does it take for them to turn their inventory? How long is the fixed asset turning over? How long are they taking to pay their suppliers, the payable period? Financial leverage, asset to equity, debt to asset, debt to equity times interest earned, like how for what they make, how many times can they pay the interest on the debt that they have, right? So debt to asset, again, from a book value to a market value, current ratio, right? Which looks at how current are their assets, so current assets over current liabilities. Asset ratio removes the quick ratio removes the inventory part of it, because you can't really get rid of inventory very quickly. So pause. Each of these, there could be hundreds of such ratios, and the book has listed some of these ratios. At some point, you'll quickly realize, hey, I've gotten enough. Is this a good investment, not a good investment? And you'll go through each one of them, right? So there's this table in table 2.5 in chapter 2, which really summarizes these equations. Like, how do I calculate profitability ratios, return on equity? It'll give you the formula. Say, hey, look at net income from the balance sheet, on the income statement, sorry, and then shareholder equity, and then look at return on assets, net income over assets, return on investment capital. So each of these formulas are given, and we need to understand really in depth how, and the basis of where to look at all of this data is through 10K, and we learned all of this in accounting. So each of these formulas are given, and I've also listed in this description the link of this PDF of this document, so you can actually look at each of these formula, and you can calculate each of this from the balance sheet, right? So you have the profitability ratios, the asset turnover ratios, the leverage ratios, and the formulas are given here. And so once we have these formulas, we can calculate these balance sheet ratios on the balance sheet, right? Add a column that says, hey, ratio, all of these ratios, right? And then find out what that table looks like, and you can quickly find out, hey, is the trend year over year getting good or getting worse, right? And then at the very end, you can even do an industry column that says, hey, what's the industry asset test look like? Industry current ratio look like, right? And in a sense, if we remember the ROE, then we are golden. And we said, hey, ROE is profitability times asset turn times leverage. But now let's really find out what profitability is. Net income over sales, asset turn, sales over assets, leverage, assets over shareholder equity. So you see all of this cancel out. Sales cancel sales, asset cancel assets. So net income over shareholder equity is return on equity. So now we understand this. We know how to start with ROE. We know how to break it down into three. ROE is the first ratio, then 3 sub ratios, and then we find out if we want to find out more detail. We go into each of these sub ratios even more and break it down further. And very quickly we can answer questions like, hey, is the product in demand? Is the management getting lazy over time? Or are they not receiving money as quickly? Or are they in pressure to pay their suppliers? Or is the leverage too high? Are they paying too much interest, right? So a lot of these questions you can quickly find out, and you can, if you had like, let's say 2 airlines, you can compare like one airline with the second airline, or one consumer goods company with the other consumer goods company. You can compare like Nike with let's say Adidas or something like that, right? So you can quickly find out like, hey, how are these 2 companies different just from these ratio analysis. So ratio analysis is super powerful. Do this for a given company and then share it in comments, like how did you find doing the ratio analysis? Did you find some patterns? And how did you use it to make a decision? So looking forward to that conversation in the chat. Thanks.